Chapter 9, Accredited Investor Banking. Stop thinking about what your money can buy and start thinking about what your money can earn. And then think what the money it earns can earn. J. L. Collins. Passive doesn't mean complacent. None of us like to make loan repayments. What if you could make those payments to yourself? Sounds like something only the super rich can do. Well, it's well within reach for those who have made it past floor 2. Repaying yourself is possible when you own your own bank, where you have control over your money, where you can store your capital in stable institutions and decrease the possibility of bank failures impacting you. That's the power of what we call accredited investor banking, or AIB for short. As you grow into a sophisticated accredited investor, your deal flow greatly increases, and the amount of your money sitting idle decreases, but you will still have natural pauses between deals. Where do you store your funds as you accumulate capital for your next $50,000 to $100,000 check for your next deal? With AIB, you use a special configuration of a whole life insurance policy that builds up cash value with uninterrupted compounding. And then you take out a loan based on the value of that policy to invest. It's a cornerstone of the wealth elevator, capital efficiency that gives you a leg up on other investors. When you act as your own bank, you are in control and able to recapture your opportunity cost losses and seamlessly feed into your next investment. As a first-generation millionaire, you may think owning your own bank seems crazy, something only the Rockefellers and JP Morgans of the world do. But if you follow the system that I have optimized from the investor banking concept, IBC predecessor, you see how easy it is for you to form your own bank, an accredited investor banking system. In this chapter, we explain exactly what AIB is and how to maximize its use, depending on which floor of the wealth elevator you're on. This can be a complex chapter with a ton of dry language, so bear with me. If you get a strong handle on what AIB can do for you, you will set yourself up for long-term success. What is AIB and how does it work? In essence, your bank allows you to make money twice. Once on the interrupted growth of the cash value in the insurance policy, and again on the investment you acquire using the policy as collateral. Said another way, you make money in two places: the policy itself and the alternative investments you acquired using the borrowed funds. When your funds are undeployed, maybe when you're saving up, your policy still grows. You do this in 3 basic steps. Number 1, you make a deposit into your policy. Number 2, you take out a loan using the value of your policy as a collateral. And number 3, you invest the money you've just earned. When real estate deals exit, investors find themselves in a windfall situation. Instead of placing these funds in a low-yield bank account, you can pay off the loan on your policy and additionally fund your policy for the optimal place to store your capital between deals, and then repeat the cycle. Think of it like having a primary residence with a HELOC on it. You pay down your mortgage along with appreciation, and your equity goes up. Then you take out a home equity loan based on the value of your house. You can use that loan to buy anything you want: a jet ski, a vacation, or for us, a share in a real estate fund or other private equity deal. Are AIBs more secure than banks? Life insurance policies are backed by a life insurance contract with a huge fortune behind it. These companies are AAA rated. They've been around for over 1.5 centuries, paying dividends since the Civil War, through depressions and many recessions. They're considered more secure than banks, essentially. Just make sure you work with a licensed broker who can steer you clear of less reputable companies. Essentially, stick with the biggest institutions for your policy backer. Here are some additional upsides of the system employed by the wealthy. More security. In tough times, banks can and do pull a loan or HELOC out from under you. We saw this happen in the mortgage crisis in 2008 and again in 2023 as credit tightened. They can also limit your loan. Even when the value of your house hasn't changed, they just conjure up a sandbagged appraisal amount on your property, giving you fewer loan proceeds to work with. With AIB, it's your money, your bank, and it's backed by the insurance companies who are much more solvent than banks. Asset protection. When O.J. Simpson, the football player, was accused of murdering someone, the courts couldn't freeze his 401k retirement money. The money was untouchable by law. The same protection is true of life insurance policies in many states. No one can touch it. At the penthouse level of the wealth elevator, You want to get as many assets as possible out of your estate for asset protection so others can't get it. Some common ways to keep assets out of your estate are through your business or in irrevocable trusts. But you also want to be able to access your funds for convenience, such as with a bank account, which is too convenient. The life insurance stays within your estate, so you can access funds, but not so convenient as a bank account or home equity line of credit. Storing a portion of your funds in your life insurance gives you a healthy balance between convenience and arm's length asset protection. Growth. When you are on floor 1 to 3, taking your money out as a loan and putting it into higher yielding investments like real estate with tax benefits makes sense. But even if you play the complacent saver and just leave the money in your policy, it grows at a dividend rate of 4 to 5%. Since it's life insurance, that return is tax free. A nice tax loophole for you as long as you configure the policy the right way with an AIB specialist. At some point in the future, when you have reached your end game, you can use this as a great storage of liquidity as you save up, or just live off the dividends. Tax benefits. You're making the dividend at a tax-free rate, and then you're borrowing those dividends. You should classify that borrowing as a business expense because you're using the money to invest in real estate or creation of income. I generally say that every strategy has its downsides, but in the case of AIB, the downside is greatly mitigated by the way the policy is configured. Life insurance policies often have very high fees, and they're inflexible when it comes to how you want to spend the policy and even how you load the funds into it. Honestly, normal whole life policies are basically a scam. Fees are the biggest concern for users, but the devil is in the dosage. You can configure your life insurance policy to drastically minimize these fees, which directly increases the immediate cash value. Most people have policies where 50 or 100% of their initial contributions go to fees, leaving them with very few funds to borrow against and invest with. That's where the insurance companies and salesmen make their commissions. So the fees are often high by default. Our team is instructed to configure the best deal for the client, which is also the low fee commission way, because we feel that this is the right business move for us. It allows clients to grow their net worth the fastest. As a result, everyone gets larger policies in the long run. The policies I personally use have 10% or even as low as 5% going into fees. That makes the policy work for real estate investors, as they are able to quickly access a larger portion of their contribution and have those funds also working outside of the policy. Flexibility of funds is the second major concern for users. Sophisticated investors used to seek policies that support being able to contribute larger amounts, such as $100,000 to $250,000 a year for multiple years. The problem was that a lot of investors didn't know their liquidity situation the next year, let alone 5 to 10 years in the future. AIB takes the guesswork out of creating a plan. It has just one lump sum payment of $100,000 to $1 million, which eliminates the need to plan future payments into coming years. Additionally, AIB allows you to flash fund quickly, so you can turn around and invest it right away. Overall, the way we designed the AIB policy is truly cutting edge, as it is optimized for fees by getting the minimal amount of insurance, where the commissions come from, while staying within the insurance companies and IRS limits to maintain the tax favorable benefits. Sounds like infinite banking. The infinite banking concept financial system has been around since the 1980s, and a lot of people use it for different purposes. When we first started working with it, we found it was not optimized for investors going in and out of private placements. The issue was contribution flexibility using the infinite banking concept system is that you are able to create a contribution plan that spans a time period of payments anywhere from 5 to 15 years. Personally, I made this mistake with my first policy where it was structured as $50,000 a year for 6 to 7 years. I eventually changed it to a lower fee policy as I found better people to work with over the years. But that's my experience. But getting back to the example, with a traditional IBC policy, you might contribute $100,000 a year for 30 plus years. But what happens if life changes and you don't have the money for that second or third year? The fees stay high and you end up spending more in fees than you make in returns. So again, that's the difference between AIB. It allows you to flash fund in 1 year and not really have to create a plan that you have to follow. That said, a lot of this is personal tailoring to your needs. We will look at both sides and we can fit you with the right strategy, but we just wanted to offer you folks different options. Fund your accredited investor banking strategy. Remember that AIB is not an investment method. It's an intermediary that can still make single digit tax free returns in the basement, and on the floor one, you don't have a lot to invest. You're getting started. We recommend not doing an AIB policy at that point because your mental bandwidth should be focused on generating income to grow your investment capital base or sourcing investments. Once your net worth exceeds $1 million on floor two, you should start to plan. Many of our clients try to flow as many investment funds through their AIB as possible and then go to investments via a loan from their AIB. This extra step creates a double dipping effect. As your policy grows, your investments grow too. If you're a business owner who has an extensive need for cash reserves of maybe $50,000 to $100,000 or more, you can use your AIB policy as a holding place for those funds. If you're an employee and you want a savings fund for emergencies or short-term savings for your kids' college tuition, which by the way, a lot of people are using this in lieu of a 529 plan or covered plan, in which I think it's a superior method. You may also want to store $50,000 or more in your AIB policy. But if you're not in any of these situations, you may be comfortable with an AIB less than $50,000. How much of your AIB policy can you use to invest? I generally recommend that clients under floor 3 take as close to a 100% loan on their policy as possible because they are in their growth years. That way, they can take those loan proceeds and invest in higher yielding real estate syndications or funds. As your net worth grows over $5 million and you reach the penthouse, you might want to pull back on growing your net worth and start to keep larger sums of liquidity in your AIB to pay back the loans on your policy if you would like. This is why you have to plan ahead and start your policy as soon as possible. You need time to create that capacity to store capital in your AIB. You're working toward your ideal end game. Once you reach the penthouse, you'll be able to put $1.5 million into the account in case of an emergency or an amazing deal, all the while making a small yield on that idle cash, tax-free and without a bank, and off the table of litigators in terms of asset protection. How much should you contribute? Refer to the chart in Chapter 2 for a reminder of how much you should contribute per floor. If your net worth is already over $1 million, I recommend a consultation with our team so that we can help you access the best rates and providers. We created a short AIB e-course for you to learn more about these accounts and their many use cases. If you already have a policy, feel free to price this out. We're confident that with our design, we will beat anyone on pricing. Quick launch plan. Many of our Wealth Elevator clients have amassed a solid net worth. They may have come in with $200,000 or more or have lazy home equity they haven't touched. They can jumpstart their AIB without the restrictions of a traditional multi-year infinite banking concept plan. This is particularly true if they have a large sum of cash but don't know what the next few years will look like, which makes a lot of sense because now that you've read this book, you've been introduced to all these cool new investing strategies. The AIB does not require a plan, just a 1-year commitment that allows you to continue to contribute in the future if capital becomes available, but doesn't obligate you to do so. With a traditional infinite banking concept plan, you create a contract for funding. If an investor has a large glut of lazy investment capital that they need to get working right away, doing a multi-year infinite banking concept would not be optimal. If you have $1 million, flash fund it into the AIB so we can invest it into real estate deals sooner than later and get this double dipping effect sooner. My personal theory is that this multi-year requirement was a typical industry sales tactic to get you to sign up for a long year term plan, just as a cell phone and cable companies used to hook you with long multi-year contracts. In the same way as the industry was disrupted, we are stepping away from the old system. That said, we can price out this option for you as well if it makes sense. AIB is a great step on the path to the penthouse. It allows you to double dip and have your money grow in two places. And once you arrive, you can start using strategies that optimize not for growth, but for liquidity and stability. Pro tips for your AIB. Here are some frequently asked questions about how to make your AIB work for you. Where is the tax deduction coming from? People often ask me, does the tax deduction come from a securities backed line of credit, an SB lock, or insurance backed line of credit, IB lock? These answers often go undiscussed, but is often a self reported expense. The way I see it, anytime I take out a loan from my AIB and pay interest on it, it is a business expense as long as the loan is helping me pursue revenue and returns. It is no different than taking a HELOC interest or a note. The same is true of an SB lock. Essentially, I'm booking the interest paid as a legitimate business expense, which further decreases my taxes. What do I do for my home purchase loan once I hit endgame? For homes under a loan size of $500,000 to $800,000, a regular government subsidized Fannie Mae Freddie Mac loan has good terms on it. The trouble is in places like California or Hawaii, or when your net worth is higher, you will want a home that is over $1.5 million. At that point, you've exceeded the limits on government subsidized loans. Third party options are terrible because they have worse rates, fees, and loan to values. If you are still looking to invest in alternative assets and will be borrowing money to invest, should you borrow money from your AIB or SB lock to invest and grow wealth? Depends if you're looking to grow your net worth quickly or slowly. If you want to grow it quickly, take a loan from your AIB to invest in value-add commercial real estate syndications. If you want to grow it slowly, take a loan from your AIB to buy your primary residence with an interest rate that beats the mortgage you would have gotten. The worst option is paying outright for cash for this primary residence. If you are still looking to methodically increase your net worth, you will still be using debt as a tool, and therefore you want to leverage either your AIB or your SB lock. In my mind, AIB is the way to go in most cases. As of this writing, it has lower borrowing costs, and you don't have to worry about margin calls. Volatility is more subtle, and your AIB is a set and forget asset, like your primary residence. Keep in mind that this can change with economic shifts, and some of our advanced clients switch between their AIB or SB lock based on the lower rate. What do most investors get hung up on? Most investors are a little uneasy about taking a loan from their AIB. They are stuck living off of the old school mindset of you pay off your debt or your loans. This is the wrong mindset to have here. Your loan is just borrowing from your own money, and you can do whatever you want with it. This is no different than taking a home equity line of credit, HELOC, from your lazy equity in your primary residence. You invest that money elsewhere to make a higher yield and arbitrage your debt service from your HELOC into investments that are stable and or backed by real estate collateral. In this case, you are borrowing money from your AIB instead of a HELOC. How do I double dip with AIB? To harness the full power of AIB, you need to double or even triple dip. Below is one working example of what is possible when you combine multiple strategies with AIB. Say you fill up the $1.5 million cash value in Accredited Investor Bank with a $10 million policy, and you take a loan at 5%, and you put it in a brokerage to buy T-bills. The T-bills give you a 90% to 95% loan-to-value ratio at the standard secured overnight financing rate, otherwise known as SOFR, at plus 2%, or 6.2% as of this writing. You throw that into a syndication or fund where you make, say, 13%. Let's assume that you have a 0.5% spread between the 5% loan charge on the AIB and the 4.5% policy dividend on the cash value. The compounding of the cash value over time will exceed the simple interest on the policy loan. For T-bills, we can assume an average 4.6 yield. You borrow at 6.2% to buy syndications or funds that yield 13%. That math doesn't work out. Negative 5% plus 4.6% minus 6.2% plus 13% equals 10.9%. When you cut through the back-to-back loans, 1.35 million of your 1.5 million earns that 10.9% yield. If you had invested directly in the fund, you would have invested $1.5 million, earning 13%. You have hit the snag. The AIB and the T-bills are causing a drag on your returns. You're not double dipping or triple dipping. In fact, you're losing less than a single dip. For this strategy to make sense, you have to earn a positive yield spread on an after-tax basis. For funds are invested in your fund or syndication, how do you do that? You allocate a portion of the assets in the brokerage account to a higher yielding asset. For the math to work, you have to get the yield above 6.2%. You could do that by going 70% T-bills and 30% JEPI, which is JP Morgan's Equity Premium Income ETF, or some other combination. Anything works. As long as at the end of the day, your 1.5 million in the AIB is earning better than it would if you invested the full $1.5 million directly. Of course, the borrowing rates and the rates of investment returns can vary, and some economic phenomena happen where SB lock and AIB rates might flip-flop. So you will need to check your math. But this is an example to illustrate what is possible. More discussion on SB locks is coming in chapter 11. But I think it also demonstrates the need to be networked within a community of kind of people hacking the system with these different tools. A common mistake. At one investor event that we hosted, I asked for a volunteer to do a hot seat in front of the others. This particular guy was playing it too safe. He had a decent net worth of 2.5 million, but he hadn't engaged in any alternative investment strategies. When I asked him why, he told me he had already had the previous generation of AIB set up. He was using his life insurance policy to fund loans. So I'm pretty set on investing, he told me. I held up both hands. Whoa, 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 I said. AIB or infinite banking is not investing. It's a great add-on strategy to then go ahead and invest, but let's make no mistake, putting money into an account and making 5% returns is great, but even if it's tax-free, it's not investing. Instead, you want to hit the wealth elevator 1, 2, 3 trifecta, which is, number 1, invest in alternative cash flowing assets, that number 2, unlock tax advantage maneuvers, and 3, use accredited investor banking last, which that this third one, AIB, is last and impacts the needle the least. A blueprint for AIB. Here's the blueprint. Contact our team at bank@thewealthelevator.com and start contributing your money to your AIB. As early as 5 business days after making a contribution, take a loan from your AIB, which is your bank, and fund real estate syndications or funds. Number 3, as your syndications and funds distribute or cash out, pay back the loans in your AIB in the same fashion as when you made contributions. Number 4, repeat step 2. And in the long term, as you start to hit your end game numbers, which you're looking for, and you want to just retire, you eventually slowly pay down the loans, or you don't have to pay back the loans if you don't want to, but you use this as kind of your slush fund for your liquidity in the future. In the next chapter, I'll talk about other ways to think about your legacy. What will you leave for the next generation?